You see the headlines, right? They're all about this explosive AI-driven growth and stock prices that are just off the charts. But what if the real story, the actual engine behind this whole boom, isn't about creating new revenue at all? What if it's about a much colder, more calculated strategy? Well, today we're going to unpack the brutal trade-off that's quietly funding the entire AI revolution and in the process, totally reshaping the modern workforce.
So here's how we're going to break it down. First, we'll start with that surface-level AI revenue hype that everyone's talking about. Then, we're going to pull back the curtain on the hidden bill for all this tech. We'll reveal the core strategy that's really at play here, what we're calling the compute for labor swap, and I'll even show you how to decode the specific language CEOs are using to signal it. And finally, we'll get into the new metrics that really define success in this era and what it all means for the future.
Okay, so let's kick things off with the story everyone thinks they know. It's this incredible, thrilling narrative about how AI is creating unprecedented wealth and, completely revolutionizing, well, pretty much everything.
But here's the thing. If you listen really closely, past all the hype, you can start to hear the code. I mean, take this quote right here. When a CEO gets on an earnings call and declares a year of efficiency, that's not just some throwaway corporate jargon. Oh no, it is a direct signal to Wall Street. It's like a secret password that unlocks the much deeper, much colder strategy we're about to get into.
And that leads us to the real question here. Is this massive tech bull run really all about creating these revolutionary new AI products? Or is there something else, something far more fundamental, that's actually powering these insane stock charts? To figure that out, we have to do what you always do. Follow the money.
And wow, is there a lot of money to follow? $3.34 trillion. That was NVIDIA's market cap when it briefly became the most valuable company on the planet. And a number that big isn't just hype, it's built on a totally insatiable demand for the one physical thing that makes all of this AI stuff possible, the computer chip.
But a revolution like this, it doesn't come cheap. In fact, it has a staggering price tag. Building the infrastructure for AI is one of the most capital-intensive projects in human history. So the real trillion-dollar question is, how on earth are these companies paying for it all?
And this is where things get really interesting, because you see this huge disconnect. Analysts are estimating that the hyperscalers, we're talking the giants, the Amazons, Googles, and Microsofts of the world, they're spending over $400 billion a year on AI infrastructure. But the new revenue that's actually coming in from enterprise AI, it's only about $100 billion. You don't have to be a math genius to see that's a $300 billion gap. And a gap like that, well, it screams bubble. A massive investment with no clear return in sight. And the spending isn't slowing down, it's actually speeding up. We are talking about a combined capital expenditure, that's the hard cash they spend on physical stuff like servers and data centers, of over $700 billion in just 1 year. This isn't just an investment anymore, it's a full-blown AI arms race, and a war like this demands a radical, even ruthless way to pay for it.
And that brings us to the core of this whole strategy. What we're seeing isn't just companies making defensive cuts to save a little money. No, this is a calculated, offensive financial maneuver. It's a play that is quietly re-engineering the very DNA of the modern corporation.
We call it the compute for labor swap, and it's brutally simple when you break it down. You treat your human payroll as a recurring expense line item that can be cut. Then you take those savings and directly reinvest them into a capital asset, things like GPUs and data centers. Now here's the absolute key. Unlike human labor, that hardware gets more powerful and more efficient every single year for the same cost. So you're swapping an inflationary cost for a deflationary, appreciating asset. It's a powerful financial move.
And look, this isn't some abstract theory. You can see it happening right now, in real time. Just look at Block, cutting 40% of its workforce to lean into intelligence tools. Or Meta, openly laying off thousands to help fund their massive AI spending. This is not about surviving a downturn. It's a fundamental re-engineering of how these companies operate.
So let's just boil this cold calculus down to a simple 4-step recipe. Step 1, the CEO gets out there and signals efficiency to the market. Step 2, they aggressively cut headcount. Step 3, they take those payroll savings and plow them right into AI infrastructure. And the final result, step 4, operating margins expand and Wall Street sends the stock price soaring.
Okay, so now that you know the playbook, how do you spot it in the wild before it's old news? Well, you have to learn the language. Let's decode the very specific words that CEOs use to broadcast this exact strategy to Wall Street.
Welcome to what some people call linguistic alpha. Now, the difference between accelerating and accelerated, it might seem tiny, right?
But to a savvy investor, it's everything. Accelerating is a verb. It's active. It signals that the revenue curve is getting steeper. Accelerated is a noun. It just describes the high-efficiency hardware itself. So when a CEO says there is accelerating demand for accelerated computing, that's the secret password. It's the ultimate tell. It means a booming market is meeting hyper-efficient tools.
And what's the payoff for all this? Well, just look at this. This is NVIDIA's operating margin. It absolutely skyrocketed from around 20% to over 60% in just 3 years. This is one of the most explosive, most historic examples of margin expansion in corporate history, and it is the absolute gold standard for this new playbook.
So if this is the new game, we can't use the old rulebook, right? The old ways of valuing a company, they're pretty much obsolete. You can forget about looking at total employees as a sign of a company's strength. In this new era, we need a new metric to find the real, truly efficient winners.
This slide, man, it just lays out the brutal truth of how Wall Street sees all this. Salesforce announces layoffs, the stock jumps 27%. Meta declares its year of efficiency, up almost 25%. The market absolutely rewards these moves. But here's the catch for a regular investor. The stock almost always peaks the very day the news breaks. The market prices in that efficiency gain almost instantly.
So if you're always a step behind just trading the news, you need a way to see what's coming. You need a leading indicator, and that indicator is revenue per employee, or RPE. It's a simple, incredibly powerful number that tells you exactly how much cash a company generates for every single person on its payroll. It's the ultimate measure of lean, mean operational leverage.
And let's put some real numbers to this so you can see what it looks like. Meta is the absolute superstar here, generating over $2.5 million in revenue for every single employee. Alphabet's not too far behind. And look at Block. Even though they use a slightly different metric, they are clearly signaling their ambition to join this elite club of hyper-efficient companies.
But it's not always that simple. You gotta dig a little deeper. Let's take Block, for instance. Their pivot to this new model is super aggressive, but you have to ask why. This chart shows that historically, they've been way less profitable than competitors like PayPal. So it raises a really critical question. Is their whole AI efficiency story a brilliant, forward-looking strategy? Or is it just a really convenient cover story for fixing years of being bloated and inefficient?
All right, so let's zoom out. What does all of this mean for the future? What's the new equilibrium, the new normal that's being created by this ruthless new playbook?
If you take one thing away from this whole explainer, please let it be this. The first wave of the AI boom, that was all about revenue hype. The next, and probably more durable phase, is going to be all about cost reduction. The real alpha, the real money, will be made by the companies who use AI not just to create shiny new products, but to fundamentally slash their operating costs.
So, this new reality, it really has 3 key features. First, this cold calculus is spreading. It's jumping from tech into other big industries. Second, that whole growth at any price era from the last decade, it's over, done. Profitability is king now. And third, and maybe most profoundly, we are watching corporate value completely decouple from human headcount. A company's worth is no longer about how many people it employs, but how lean and efficient it can be.
And all of this, it leaves us with one final and pretty provocative question. This entire strategy is built on the idea of turning intelligence into a cheap, scalable commodity, like electricity. If that really is the future we're building, what then is the new, irreplaceable value of human capital?